Move on to the market with some news for you. Nigeria's June inflation dropped to 8.4% from 9% in May, reflecting the impact of the central bank's tight monetary policy, and the fall is linked to an improvement in core inflation, which fell to 5.5% in June from 6.2% in May, while the food price index was up 9.6% compared to 9.3% in May. And to unpack the numbers and to get an outlook for the economy going forward, I'm now joined by Usoro Essien, his head economic intelligence and strategy at Associated Discount. Thank you so much for joining us, Usoro. So I think it was pretty much in line with most expectations that we're going to see a fall. We've now seen inflation below 10% since December 2012. And I think this is something that may begin to impact particularly the fixed income market if it's sustainable. Where do you think inflation is likely to go from here?
Well, for the rest of the year, H2, we expected single digit. We actually expected to reduce marginally before December. And we'll probably have a very low figure.
So sub 8%, you think?
Not really. We may get a one-off dip, 7.9, but that's way later in the year. It's around 8% levels, but just slightly lower than 8.4.
Where do you think we will end the year, though?
We'll probably end the year around 8.0% December.
Right.
Yeah.
Right.
All things being equal, the core index, as you said, in 2012 was so elevated from the fuel subsidy to the hikes in the MITO tariff, the 5-year plan.
Yeah.
These and also the pressures on the naira. You know,
Right.
June 2012, naira traded at 162.50. So even though the pressures now suggest that there's pressure on the naira, it wasn't as the impact is not as heavy as it was last year.
Right, but we have seen some pressure on the naira. And do you think this is reflected at all in the numbers we're seeing for June?
No, it is. Basically, if you look at the core index now, if you've imported goods at the rate at 162.5 in June on average, and you now imported this year at 160, it means that your goods will actually be cheaper this 2013. So even though there are pressures on the naira now, the domino effect we had last year, we had pressure on the naira, we had electricity tariffs, we had the fuel subsidy, we also had the decline in reserves, funny enough, about $1 billion US dollars in June. So those actually put heavy pressure on core index. We had 15.2 in June. It dropped to 14.9, 14.7.
Right.
So a 5.5. In the past 3 years, we haven't had 5.5.
It's looking pretty low, and like I mentioned in the intro there, it's really reflecting the impact of the tight monetary policy.
Yes.
A lot of people saying that it's about time we get some relaxation of that policy. Do you share that sentiment?
Well, I actually feel the room for easing this year has actually passed. And why I say that is, you remember what people tend to forget about the inflation indices. The headline inflation is a year-on-year change.
Yeah.
Month on month, it actually inches.
But even month to month, it's still. Last year we're doing 1%, 1.5.
Yeah, but
now
the change is
like half
zero,
percent.
half percent. Yeah, but the impending threats still exist.
Right.
You expect government spending to increase significantly next year.
Yeah.
In fact, from Q1 2014 to Q4, you expect government spending. And because of the low base this year, the year-on-year change will most likely reflect a higher inflation rate in 2014. So you probably get back to double digits in 2014.
Right.
And the CBN does not have the luxury of, giving you incessant tweaks. They would want a lot, like a lasting outlook. So they basically don't have that luxury to tighten. So
next week, you think they're going to maintain the status quo?
I think they'll maintain the status quo because there's really no room for easing.
The headwinds.
Because of the headwinds.
Okay, let's talk a bit about the food inflation number. That went up to 9.6 year on year.
Largely expected.
So you said largely expected. Why?
Yeah, but if you note the inflation note that they sent out, MBS last month, they actually complained that inventories had started drawing down. This is the planting season.
Yeah.
You have things like a new yam coming up now, and the old and tasty yam and things like that tend to be very pricey at this point. And going forward, remember there was a flood last year, so the inventories anyway were not at the normal levels they were. So there's a significant decline. The Ramadan also is coming up, it's already started this month.
Yeah.
And you expect the supply, the route to market for a lot of goods from the north to slightly slow down. So the strain in supply would mean prices go up, basically. But however, because of our core base last year, it would mute all these effects, on a year-on-year basis. But if you look at the month-on-month, you see a climb, on the percentage points.
You mentioned the issue of the flood last year, which of course, I think a lot of people are a bit surprised at how well we coped with that. Are you surprised that the impact hasn't been as bad as initially feared?
Well, last year, there were good relief measures taken. Right. Some state governments, even the federal government, they had a fund. But the major thing is the domino effects last year were such that there was really nothing we couldn't absorb, from the fuel subsidy to the price increments across board, Yeah. So even though the flooding could have been significant if it was a one-off event, if it was the only factor we were considering, then it kind of just rode with the tide. Yeah.
Right. Okay, so let's bring it back to the markets now. Look at the fixed income market.
Okay.
How is the yield curve likely to react to all of this in your view? Because now we're seeing a really massive premium over inflation now.
Sure. Yeah, there is. However, this inflation, for most investment houses that have good research, they've already factored it in, because, as you said, it's a consensus. It's largely expected.
Right.
What they really look at is demand. A lot of yields and interest rates, be it on T-bills or on bonds, were compressed by what you would call FPI inflows.
Yeah.
And that happened because as we were tightening, as we started tightening in 2011, the US, to stimulate growth, were easing. So cheap money was available, both in our equity market and in the fixed income. So right now, as you said, there's a premium. There's a premium, the 90-day T-bill, even if it's at 10%, there's a premium of like 1 point. Yeah, it's still above inflation, and that's the mindset you take. However, you want to also estimate demand. If you do not see demand levels, month on month or quarter on quarter around the same, then you'd be slightly cautious at how you price your entry point.
Right. But don't you think this the inflation number itself should generate some demand, especially from abroad? Because if the consensus is that we're going to see inflation, like you said, maybe 8% at the end of the year, definitely there's enough room to take Nigeria's risk. Although some will also argue that you also need to look at the currency. It's
key because even if you have a premium of 1.6%, a 5%, an above 5% depreciation in your currency exchange rate erodes your profit.
Right.
So the naira has to be stable. We have to start accruing reserves. The good thing is, for some reason, crude has actually been on the uptick. Brent, last I checked, 109. Bonnie Light is about a $3 difference from that. So hopefully we should see accretion, maybe if it continues next month, with the fact that we've fixed the pipelines, because production has been the main bane of the. If we can start building our reserves, no matter how small, but they stop declining.
So you are positive about the naira going forward for the rest of the year?
No, definitely. The naira can. We have reserves to back the naira at 160, 161 levels.
So 161 thereabout, you think we would stay there?
Definitely.